Good afternoon, my dear student. Welcome this particular session, which is known as BOS for your success, which is organized by Board of Studies of your institute. And today we'll be discussing about CA Intermediate Paper 8A, that is Financial Management. And myself, Dr. N.N. Sengupta, and with me, my colleague, CA Mayank Jain, would like to welcome you all in this particular session. Already, I have seen that you have started sending your queries and your doubts for this particular session. I am sure that it will be an interactive session. From exam point of view, this session is going to be very, very important because certain examination tips which we feel is necessary that also we'll be sharing on behalf of Board of Studies, right? And whatever the query is there in your mind, I would like that you should express yourself and send your queries. I can assure you that we'll try our level best to give the answer of each and every query, whatever you will be sending. Briefly, before going into the PowerPoint presentation and discussing details, very quickly, let me tell it to you that what are the things we will be discussing. We will be discussing the syllabus and the section-wise weightage. We will be discussing the skill-wise or weightage as well. So this is basically how much theoretical and how much practical question you have. Say syllabus section-wise also we'll be discussing, as I told you, what are the section, what is the percentage of question which generally comes from that particular section. Then we'll discuss the structure of the question paper, what kind of question paper generally we see. Means first question, how many marks, second question, how many marks, how many total questions will be there, which are the theoretical question. Summary of each chapter very quickly and important points to remember. This is very important from examination point of view. How to revise, this is again from examination point of view. And then at last we'll be discussing examination do's and do nots. Now, when I'm discussing the financial management, this is one of the, I think, very scoring paper. If you can study it properly, I think Mayank will agree with me. But obviously, if you ignore it, then this paper can be very difficult as well. Now, financial management, if you see from finance function perspective, there are three functions basically which is dealt in this particular subject. One is known as financing decision, one is known as investment decision, another is known as dividend decision. And then these are basically which goes on for a longer period of time. And then there is a short-term decision which is working capital management. So if you talk about financing decision, basically the capital structure and leverage we need to take into consideration. Investment decision, we talk about cost of capital as well as capital budgeting. Dividend decision, obviously dividend policy, how much to give, how much to retain. Then there is working capital management, which is known as lifeblood of an organization, means how much working capital should be there in the organization, what kind of working capital should be good for the organization, how we can finance those working capital, what can be the aggressive policy, what can be the defensive policy, how we can calculate that what is my working capital requirement, how much working capital I require. Then we can also decide that what is the operating cycle. What is operating cycle? Raw material moves into WIP. WIP moves into finished goods. Finished goods goes as debtor or sales. Then again from that cash we purchase the raw material. So how much is there this cycle? This is known as operating cycle. We take the creditors also in consideration in this particular operating cycle. And then there are three very important components. One is inventory management, which is also dealt in your cost and management accounting paper. Second is very, very important, receivable management, what we are supposed to receive. And the third, the most liquid asset of the world, that is cash. So how you are dealing these three, that will be dealt in short-term decision making, which is known as working capital management. And my dear student, exactly this is your syllabus. So your syllabus is nothing but the overall finance function. And also you need to know that how the role of finance manager has changed over a period of time. Okay. So with this particular note, let us start our presentation and our discussion. And Thank you very much, Mohit, for welcoming me as well as my colleague Mayank. And yes, cash management, Mohit, absolutely correct. Very good. While attempting the problem, it is difficult to identify that is from which chapter. If that is the problem, Kiran, then your conceptual clarity is not there. If your conceptual clarity is there, very easily you can identify. And that's why I told you once again, telling you again and again that please go through the study material of the institute and go in that particular flow so that your each and every concept becomes very clear, right? So let us go through the presentation one by one, and you can send your query. Thank you very much, Mayank, for joining. Mayank will be sharing his thought process in the next class. But since this is basically a hand-holding class, we thought of taking one-to-one queries. Thank you very much. So syllabus and section-wise weightage, that we'll be discussing now. In the first part of section-wise weightage, you can see that there are two very important parts. One is the introduction to financial management function and financial analysis through ratio. This section-wise weightage is 10 to 15%, which comprises of 7 to 10 marks, right? Then the second part, which is financing decision, sources of finance, short-term, long-term, lease, sell and lease back, convertible bond, venture capital, angel finance. Then there is cost of capital, weighted average cost of capital, marginal cost of capital, factors of cost of capital, how we can calculate all this cost of debt, cost of equity, everything that will be dealt in cost of capital. Then there is capital structure. There are four concepts in capital structure, as we all know. One is going to be the traditional concept. Then there is going to be NI approach, NOI approach, net income approach, net operating income approach, traditional approach, and Modigliani and Miller approach, the last one, which basically says that capital structure is irrelevant, and leverage as well. So this is a very important segment. 40 to 45%, 29 to 33 marks basically comprises of this. Now, as we further go on to the third section, there is capital investment decision, that is capital budgeting. There is risk and uncertainty in capital budgeting. So the probability analysis, RADR, that is risk adjusted discount rate, then scenario analysis and sensitivity analysis, that is going to be very important. Then dividend decision. What are the basis of dividend? What are the forms of dividend? What are the different approach of dividend? Walter model, Gordon model, as well as Modigliani and Miller approach. There are certain small model like Burden theory and all that also you can go through. And the last part of management working capital, which is basically the short-term function of management, that is 10 to 15%, that is of 8 to 10 marks. So these four comprising basically of the subject financial management. Level wise, if you see skill level wise, level 1 is of 20 to 30% marks. Level 2 is of 70 to 80% marks. Structure of question paper, compulsory question consisting of 4 numerical question of 5 marks, that is of 20. Question can consist of sub question of any mark combination, that is for 10 into 4, that is 40. Then question which is basically theoretical in nature, including one internal choice of 2 marks, that is 12. So total is 72. Out of 10 marks is the general choice. So in the very first chapter, what are the things? Already I told you that what are the various functions, what are the decision making which the finance management does or the financial manager does. That is your investment decision, your financing decision, and your dividend decision. Then in short-term decision making, the working capital management will be there, and scope and objective of financial management, that's going to be very important for you. Then profit maximization vis-a-vis the wealth maximization. What are the difference between the two? Then role and functions of CFO. What is the role? What is the function? What is the difference? What is the relationship of financial management with other discipline of accounting? So that's another part which is to be decided or which you can also study in this particular chapter. Then the sources of finance or type of financing generally based on maturity, we have long term, we have medium term, we have short term, and based on the basic sources, we have internal sources, mainly the retained earning. What is retained earning? The part of earning which is retained by the organization to be reinvested for some other purpose. Then external sources, there is share capital, there is debt and borrowed capital. In share capital, there is equity share, there is preference share. In debt and borrowed capital, there is debenture, there is loan from financial institution and other aspect. As per the sources of finance concerned, long-term sources, there is share capital, retained earning, debenture, loan from financial institution, loan from state financial corporation, loan from commercial banks, venture capital, asset securitization. In the medium, preference share can be there, debenture can be there, mid-term loan, then lease financing, like that, ECB, external commercial borrowing, short-term commercial paper, trade credit, advance receipt from customer, all these things can be there. Some of the very, very important terms you must go through, like venture capital, debt securitization, lease financing, masala bond, and breach finance. All these terms, terminologies are very, very important for you. Then we come to the third chapter. If you have any question, you please put your question. Confident, if you are not confident, Kiran, that is a good sign basically. You practice more and more, you will become more and more confident. So if you are not satisfied with your performance or your preparation, that's a very good sign. Means you need to practice more, you need to study more, right? So that's a positive sign what you are getting. You strive in, you try for further accuracy, try for further practice. Practice will make you perfect. Clear your concept, write down your concept in a piece of paper or in your notebook, and then you go through the solution, the practical problem, whichever is there in the notebook. Then financial analysis and planning. In the ratio analysis, type of ratios, there is liquidity ratio, leverage ratio, activity ratio, and profitability ratio. So these four ratios are included there. Then there is a capital structure ratio and coverage ratio as part of the leverage ratio. Then profitability ratio related to sales, related to overall return on investment, capital employed, required to analyze from owner's point of view, related to market, oblique valuation, oblique investors. So these are the profitability ratios and these are the leverage ratio or the solvency ratio. Now, as per the liquidity ratio is concerned, current ratio, current asset by current liability, quick ratio, quick asset by quick liability or current liability. Then these are the two very important ratios of liquidity. In case of coverage ratio, DSCR, I think one of the most prominent ratio, and interest coverage ratio is also very, very important. Then in capital structure, you can have debt equity ratio, you can have debt to equity ratio, debt ratio, capital gearing ratio, and proprietary ratio. Profitability, ROI, ROA, and ROCE. Now, generally, we talk about return on investment. What is return on investment? You should study more the concepts and you should practice the numericals, the numerical chapters. For an example, cost of capital, capital structure, leverage, capital budgeting, risk analysis in capital budgeting, dividend decision, and working capital management. In working capital management, inventory, receivable management, and little bit of cash management as well, particularly those two models. What do you mean by ROI? What is the meaning of ROI? Return on investment, right? What is return? Okay, then what is investment? Fine. Now return can be net profit, return can be various things. Similarly, investment, you told what is investment? Net worth. Okay. Capital employed. Okay. Asset. Fine. Equity. So both return and in your investment can vary. So ROI is, though ROI is very simple, return by investment, but this return can vary and this investment can vary. When it will be profit, it will be net profit after tax by total asset. Total asset again can be divided into two parts. One is known as ROTA, that is ROTA, return on total asset. Okay. And another can be RONA, not the Hindi RONA or crying, but it is RONA, that is return on net asset. Okay. So total asset can be ROTA or it can be RONA. Fine. So that is one type of return on investment, which is known as return on asset. Then second type of return on investment is going to be return on capital employed. Return on capital employed. That is, return is going to be there and there is going to be capital employed. Now, what is capital employed? What are the equity share? What are the preference share you have in your organization? Again, return on capital employed can be pre-tax as well as post-tax. When you are taking pre-tax, you will be taking EBIT. When you will be taking post-tax, you will be taking EBIT into 1 minus T. Then return on equity, net profit after tax minus preference dividend. If any preference dividend is there, you should be able to eliminate that. You should be able to minus that or deduct that divided by the equity shareholders fund. Got it? So all are return on investment. So sometime in the question it is said return on investment, but if you have only asset, so your return on investment means what? Return on asset. So many times we have seen that you get confused. That return on investment may be a particular thing. It may be ROC, it may be ROE, it may be ROA. Got my point? So based on the figures which is given in the question, you should be able to drive yourself that what is the requirement of that particular question, and accordingly you should be able to solve it. Clear? Then there can be profitability ratio based on sales. There can be GP ratio, that is gross profit ratio. There can be net profit ratio. There can be operating profit ratio. There can be cost of goods sold ratio. Then operating ratio, financial expenses ratio. So ratios can be divided in this way. Then efficiency wise, one thing you please keep in mind that when the turnover ratio is there, normally the turnover ratio can be based on sales or cost of goods sold. Now, what is the difference between sales and cost of goods sold? Anybody? What differentiates sales with cost of goods sold? Anybody? Very quickly. We are in third chapter only. We need to cover 7 other. The difference between sales and cost of goods sold is profit. Absolutely correct. Absolutely correct. So that means when you are taking sales into consideration, it means you are taking the profit element also into account. When you are taking cost of goods sold, you are not taking the profit element into consideration. You are only taking the cost part of it. So when you will be calculating different ratios like inventory, for an example, what you will be taking, what is the preferred one? Cost of goods sold. Yes. Because in inventory, we do not take the profit part into consideration. When you will be taking debtor turnover, you will be taking the credit sale, not the cash sale. Now, any turnover, debtor turnover or payable turnover is there. If you want to calculate in days, what you will be doing, you will be taking the total number of days in a year, that is 360 or 365, divided by that particular turnover. So let's say turnover is coming 10. So 360 divided by 10, that is 36. So that is 36 days you take to collect the money, which is also known as average collection period, right? So this is the way we calculate or we think. So do not try to memorize the formula. Clear your concept, keep in your mind so that you can apply the formula as and when it is there. Yes, Naveen Babu, you are correct. Kiran, again, you are correct. Yes, you are correct. Chanchal also. So the differentiation between the sales and cost of goods sold is the profit element. So when you take cost of goods sold, mind you, you are not taking the profit element. When you are taking the sales, nowadays we have seen that in the question paper also it is mentioned whether it is on sales and cost of sales. If it is not mentioned, it can be both. But normally inventory or where you should not be taking the profit element, it should be based on COGS. Otherwise, when you will be taking the profit element, it should be based on sales. Absolutely correct, Sahu. SK Sahu, you are correct. Sales is the gross proceed against the supply of goods. Absolutely correct. Okay. So now for owner's point of view, who are the owner? Shareholders, right? From shareholders' point of view, you can try to see EPS, you can try to see DPS, you can try to see DP ratio, PE ratio, dividend yield, earning yield, market value, Q ratio, etc., etc. Then various important points to remember: preparation of balance sheet using the ratio, determination of different kind of ratio, calculation of different ratios when the other ratios are given, determining different ratio when the balance sheet and income statement is given. So these are the type of question you can see, and each type of questions is there in the study material. You please go through those type of questions. So this is one question which probably you can solve. Let us skip it through. Now any question related to the first three chapters, because now I'll be proceeding to cost of capital. Thanks for your active participation. No, it's not good morning, it's good afternoon actually. Right. Any question from this first three chapter very quickly? Fine, good. Shall we start cost of capital? What is cost of capital, by the way? What is your concept? What do you think about cost of capital? Okay, cost of acquiring capital. Any other? Yes, minimum rate of return which you should have. So cost of capital is also known as discount rate when you do the capital budgeting or the project analysis. It is also known as hurdle rate. Absolutely correct. Very good. So what are generally the sources of finance we have? Debt, then equity, preference share also. Though preference share is not preferred nowadays, but then also we need to know the preference share. Then equity, yes. And also we have retained earning, the part of profit which is retained by the organization and reinvested further. So you have correct debt. Yes, debenture is a part type of debt. Thank you, Chanchal. We are always there. Any question you have? Management of receivable, you need to clear your concept, Kiran. Then only it will be easy. And then you practice various type of question. All question of study material plus at least 5-6 terms question paper plus RTP and MTPs. Yes, Mohit. Very good. Kiran. Absolutely correct. Naveen. Bonds. Yes. So debt comprising bonds, debt comprising debenture or any kind of loan, etc. So we can calculate the cost of debt. Now, debt means what? When you are paying the interest, you will be getting a tax benefit out of it. So debt can be before tax or debt can be after tax, right? So cost of debt can be after tax, cost of debt can be before tax. Okay? Then there is preference share. Whether preference share also will be before tax and after tax? No, because preference dividend is given after paying the tax, right? So preference share cost can be calculated only once. There is no classification required whether it is before tax or after tax. Is it clear? Mind you, if there is any debenture which is to be redeemed, when there is a redemption of debenture or there is a redemption of preference share, you need to calculate the cost in a different way, right? Then the third one, which is cost of equity, which is the owner's capital. Now you may feel that, sir, why we should be calculating the owner's capital? Because the opportunity cost we need to calculate. So cost of debt, you can see here, this is with tax irredeemable and this is redeemable. Similarly, preference share capital, this is irredeemable and this is redeemable. Cost of equity share capital, then the dividend price approach, the DP approach. DP approach is there, then dividend divided by the price, then EP approach, earning divided by price, then growth approach, dividend by price plus growth, realized yield approach, past records of dividend. Then there is CAPM, that is cost of equity is equal to risk-free rate plus beta into market return minus risk-free rate. And third is the cost of return, where the personal tax may also be taken into consideration. So a lot of time we take the cost of equity into consideration and then we take the personal tax, we deduct the personal tax only. What are the important things? What are the important question which comes in this cost of capital? Yes. Okay. So calculation of cost of debenture, preference share and equity share, calculation of WCC using book value weight and market value weight, determination of revised WSCC and revised cost of debenture, preference share and equity share, calculation of marginal cost of capital, determination of existing and new weighted average cost of capital. So there are certain questions which is there in the study material. You can practice. Any question from cost of capital? No need to memorize, Sahu. Only you can remember the important ratios and then you understand what is the logic behind it and do the practice of numerical. While practicing the numerical, the ratios automatically will start coming in your mind. But if you memorize and practice only one or two questions, you will not be able to recall that in examination condition. Is it clear, Mr. Sahu? Read the ratios, important ratios you remember, write down one or two times and then practice numericals. Also, you will find which ratios to be applied at which place. Is it clear? Fine. Shall I go to the next one? Okay. Any doubt in any of the chapter? First, second, third, fourth. So far we have covered. Again, Mohit, cost of capital, I have given you a chart, this one. Write down in your notebook 2 to 3 times and then you practice numerical. Nobody can stop you from attempting the question of cost of capital. One of the most easy way to calculate it. And then you apply the concept of weighted average, marginal cost of capital and all. All clear? I hope all clear does not signify the shampoo all clear. All clear means your doubts is clear. Am I correct? Kiran? Yes, Sahu. Very good. Very good. Thank you very much. Right. Shall we go to the next one? So, two part in capital structure decision. This is a financing decision, mind you. One is that there are four approaches of capital structure: NI approach, traditional approach, NOI approach, and Modigliani-Miller approach. This first three says whatever may be your capital structure does not matter. The value of firm will not be changed. MM says capital structure is important in deciding the value of a firm, and there are two kind of MM hypothesis. One is with tax, one is without tax. Then there is financial hierarchy. There are two concepts. One is the trade-off theory, another is the pecking order theory. And then EBIT EPS analysis, designing an optimal capital structure. Capital structure theory, there is relevance theory. Already I told you, NI approach. So that is basically how we can calculate the value of the equity. That is the net income divided by the cost of equity. Then traditional approach, which is the balance between the NI approach and NOI approach. And NOI approach basically suggests net operating income divided by cost of overall capital. And then the Modigliani-Miller approach, there is with tax, this one. So this one is very important. And without tax, this one is also very important. So Modigliani-Miller, you need to go through again and again and all remember all this while going through the study material. Now EBIT analysis. EBIT analysis, if you do the EBIT analysis like this, then you will see there will be a point in which the EPS will be the same. So EBIT EPS basically signifies that there will be a point which is known as indifference point. What is the name? Indifference point. And at that particular point, at that particular EBIT, the earning per share will be equal in both the cases. Then there is important points to remember. Different question on different approach like NI approach, NOI approach. So if there is an approach which is mentioned, you would solve the problem according to that approach. Then what is the better financial plan? You have to calculate the EPS. How EPS is calculated? Anybody? EBIT? Yes, you will start with EBIT, then interest, then EBT, after EBT tax, then it comes profit after tax, then preference dividend if there is any preference dividend, and this to be divided by number of share. That will be earning per share, right? Any question from capital structure? Any doubt? Yes. Chanchal, Kiran, Sahu, Mohit, Babu, Naveen Babu. Any doubt? Otherwise, we'll be going for the next one. Any doubt? Very quickly. I am just waiting if there is any. Earnings available, yes, that is EPS. Absolutely correct, Naveen. Earning available to equity shareholder divided by number of equity share. So where in which particular plan the earning per share will be more, that will be the better plan. So evaluating a plan question comes also in examination. Last time also there was a question. So no doubt, Chanchal, Mohit, you can give diagram, indifference point diagram you can give definitely. Yes, we'll be starting the next one. Very good. Fine. So now, while discussing the profitability statement, sales less variable cost, contribution less fixed cost, that is operating profit less interest, earning before tax less tax, profit after tax, then preference dividend, then the net earnings, then if you divide it by number of share, earning per share will be there. Now you can see this is the fixed cost. So the ratio between these two, contribution and EBIT, this is your operating leverage. And any changes in EBIT and sales will be measured as degree of operating leverage. Next, EBIT less interest, that is EBT. Okay. So this is another fixed interest, and EBIT by EBT, this will be signified as financial leverage. And any change in EPS and the EBIT, that will be known as degree of financial leverage. And when we will combine these two, this will be degree of combined leverage, right? So no need to remember any formula, not a single formula you need to remember. So operating leverage, contribution by EBIT, and percentage of change in EBIT by sales. Financial leverage is EBIT by EBT and percentage of changes in EPS by EBIT. And if you multiply both, that is contribution by EBIT, that is from the very beginning, from the very last one, EPS to sales. Any changes here, how we are measuring, that is basically combined leverage. So there are two very important aspects of financial leverage. Leverage chapter, there is no separate weightage. Leverage is a part of the second segment where cost of capital is also there, capital structure is also there, leverage is also there. Right, Chanchal? Generally, we see one numerical question comes from leverage in general, but nothing is predicted. There is no guarantee, not even warranty. Okay. Now there are two very important terms in case of financial leverage. One is the trading on equity. So trading on equity, when you talk about financial leverage, we use the fund with the fixed cost in place of equity share capital. So there is a trade-off between equity and debt. So we more strive for long-term debt, and when there is a trading on equity, it means we are more depending on fixed cost fund rather than the equity capital. So in good time, in happy time, high financial leverage can give you lot of return, very high return and high EPS. But in the time of recession, when your EBIT is not very high, then your trading on equity can be double-edged sword. One time, when your return on investment is more than the cost of debt, it will be surplus. Equity shareholders will be happy. But when the return on investment goes down, then it will be just opposite situation. You can see in the first situation, 25% was ROI and cost of debt was 15%. So 10% surplus was received to equity shareholder, that is earning per share. And in case of 5% deficit to be borne by the equity shareholder, that is EPS. Then important points to remember. questions based on calculation of different leverage, determination of percentage change in figures, theoretical questions on leverage, calculation of leverage when the balance sheet of item given, and preparation of income statement when any leverage value is given. Even there is no income statement, when there is a question, you will try to prepare an income statement. Things will be very easy for you. Sales, variable cost, contribution, EBIT, EBT, profit after tax, and EPS. If you can find any kind of leverage is there, you will be able to solve it. So there is some question of leverage. I am not going through it since more we are focusing on the conceptual part. Any doubt in leverage? Initial cash outflow, how we can calculate in capital budgeting, then how we can calculate the incremental cash flow, and year end or terminal. What is the meaning of terminal? The last year, when you were selling the machinery on scrap, that is the terminal year incremental cash flow. So how we can determine that has been shown here. So in the chart format also, I'll just show it to you. So if sales unit is there, you multiply by selling unit, you will get total sales. Then variable cost is contribution. Then fixed cost, that is cash cost as well as depreciation, that is EBT. Less tax, that is earning after tax. Then depreciation, if you add, it will be cash flow. Block of assets and depreciation, exclusion of financial cost principle, and post tax principle. These are the things which you need to keep in your mind. Block of asset concept, already I told you that sometime the question can be there from this. You will be very, very, thorough if you practice those kind of questions. When the straight line value will be applied and when the written down value will be there. So this is a concept. Sometime it is applied. So you should be careful about that. I think the same. Yes. Same answer sheet. Yes. Leverage basically means how much advantage you are taking by either employing fixed cost or the interest. So when you are taking debt, one side you are paying interest, another side you are getting the tax benefit. So you need to balance it, that how much advantage you can get and how much it can be disadvantageous. So accordingly you will decide what will be your operating leverage and what will be your financial leverage. Operating leverage signifies fixed cost and financial leverage signifies the interest on debt or interest on loan or interest on debenture. Right, Saul? So in between, I'm trying to cater your queries. Now, capital budgeting technique, there is payback period. Payback period can be without discount and with discount. Then there is accounting rate of return. Then time adjusted, there can be NPV, net present value, whatever may be the present value of cash flow minus the investment. Then there can be profitability index. So all present value of inflow divided by the outflow or the present value of outflow. Then there will be internal rate of return. What is the meaning of that? Let's say at 10% rate, you got an NPV of, let's say, minus 3,000. And let's say in 17%, you have got an NPV of, let's say, or this can be plus, and you can get minus 2,000 for an example. So there will be some percentage where the NPV will be zero. So internal rate of return is that percentage at which your present value of inflow will be equal to present value of outflow. Correct? So that is known as internal rate of return. How you can calculate? You can take the lower rate, then NPV at the lower rate, then the difference between the NPV of lower rate and higher rate, and then the difference between higher rate and the lower rate here. Then there can be modified internal rate of return, MARR, and discounted payback. Already I told you. Payback means what? I've invested 10 crore. Within how many years my money will be paid back to me? So that number of year, month, days, or the period is basically known as the payback period, right? Important points to remember in this: there can be theoretical question, advantage, capital rationing, NPV versus PI, those kind of MIRR, all those kind of question. Then whether a project should be accepted or not, acceptance or project or not, that can be there. Then question based on the replacement of old machinery, new machinery. Then ranking of two kind of proposal, which should be taken first and which should be taken second. So this is one simple question. Only thing I'll tell it to you that this is how we calculate the payback period. This is how we calculate the NPV. This is the cash outflow, which is 80 lakh minus 97 lakh. This is at what percent? 10%. So 17 lakh 92,000. And this is a profitability index. And when you will be calculating, so earlier we have taken 10%, now we are taking 15%. So 10%, what was the NPV? It was positive, but I have hiked the percentage. So by way of doing that, my NPV has come negative. So there will be IRR between 10% and 15%, that we can determine with this, which is known as interpolation of statistics. Okay. So if you can use that interpolation of statistics, you will be able to calculate the internal rate of return of this particular project, which has come as 14.77. IRR is one particular rate of return. MIRR with adjusted or modified internal rate of return. Based on the change circumstances, the internal rate of return is changing. So that is basically known as MIRR. So in case of MIRR, it basically says that there can be multiple rate of return. Right? So these are the 5 concepts which is there in case of capital budgeting. Any question from capital budgeting? Shall we go to the next one? In case of risk analysis and capital budgeting, because under normal circumstances of capital budgeting, we assume that everything is perfect. There is no risk, there is no uncertainty. But in practical circumstances, that is not the case. In practical circumstances, you will see there is risk also, there is uncertainty also. So when you will be factoring those into account, that will be basically known as risk analysis in capital budgeting. Now, techniques of risk analysis in capital budgeting is statistical techniques, conventional technique, and other technique. In case of statistical technique, there can be probability, there can be variance, there can be coefficient of variance. Then in case of conventional RADR, that is risk adjusted discounting rate, and certainty equivalent, and other technique can be sensitivity analysis and scenario analysis. So these are different ways we calculate. This is all taken from your study material only. So you can calculate expected net cash flow, expected net present value. There are certain numericals also. You can go through that. There is variance, there is standard deviation, coefficient of variance, which is basically takes into account both SD. SD means standard deduction, standard deviation, not reduction. So there is no tax involved in it. Then expected return or expected cash flow. Then RADR, which is risk-free rates plus some premium. Certainty equivalent, to make that surely these things will be will be applicable. That is basically certainty equivalent. Then sensitivity analysis, what if analysis. If this changes, then what will happen? If this goes high, then what will happen? If this decreases, then what will happen? So basically keeping changing those figures and try to find out that which factor is more sensitive. That is known as sensitivity analysis. Scenario analysis, although the sensitivity analysis is probably the most widely used one, it does not have any limitation as such. So it's based on different scenario. IRR and MIRR. IRR is clear. Internal rate of return. MIRR will happen when you will be assuming a single outflow in the 0th year. Okay. So IRR is a simple internal rate of return where the NPV is 0. But there can be multiple outflow. Investment can be multiple, first time, second time, third time. But in case of IRR, in case of MIRR, the outflow will be only once. Single one, right? Now, carrying on with this is where three type of question we see: expected cash flow, SD and variance and coefficient variance, then RADR calculation, certainty equivalent calculation, and sensitivity and scenario analysis. Basically, the numerical question or short notes we see in this particular chapter. So this is one question which has been solved. And now the dividend decision. In case of dividend decision, there are two kind of concept. One is irrelevance, that is dividend is irrelevant, and Walter model, Gordon model are basically advocating that. Then there is relevance theory where dividend is relevant, and there is other model like dividend discount model, Graham-Dodd model, and Linter's model, etc. So based on this particular model, you can summarize that how the price of equity share can be calculated based on situation. Mind you, in Gordon model, there are two kind of model. One does not calculate the growth into account, and another one takes growth into accounts. What is this BR? B is the retention ratio, and R is the return. So when you are retaining the money and you are applying the growth factor on that, that is basically known as BR. Then dividend discount model, it can be zero growth model, it can be constant growth model, it can be variable growth model. There is Graham-Dodd model also where something is assumed. Then there is Linter's model. So just go through this particular model and practice all those questions. Effect of dividend, we see their bonus share, right share. Mind you, bonus share can also be known as scrip dividend. Okay. The word can be different somewhere. Always it may not be mentioned in your question. Calculation of market price using a different kind of model, dividend model, Walter, Gordon, etc. Then calculation of market price using the dividend payout ratio, that is DP ratio. So these are some numerical based on the Walter's model. You can go through that. And at last, now we'll be discussing about the introduction to working capital management. Current asset and current liability normally we know as working capital. When you talk about gross working capital, basically the fund which you are deploying on current asset, but net working capital is the difference between the two. Introduction to working capital management, estimating and operating. Then treasury and cash management, management of inventory, that is the inventory management. Then receivable management. Some people feels that is a difficult part, but a very important part. Again, you go through the study material, clear your concept. What do you mean by credit sale? What do you mean by credit policy? When it will be going up? What will be going up? What is the opportunity cost? What is factoring? How factoring is going to help you? What are the cost of factoring? And then taking a decision based on the organization. So approach of evaluation and financing receivable. These are very important part. Operating cycle calculation. So this has been shown. This is again taken from study material itself. These are how the working capital requirement can be calculated. So this is one question based on that. In the working capital chapter, there can be question based on uh, operating cycle, preparation of statement of operating working capital with different ratios, calculation of estimated working capital, preparation of cash budget, cash formulas like Baumol model and OR model. Then there can be theoretical questions on different concepts. Right? Most easy chapter of module 1. Which one you feel, Mohit? All are easy. Any question? Okay. Now how to revise? Many of you were asking how to revise, sir, at the last moment. So now there is a financial management reference book. You can use that for quick revision, which is available also in BOS Knowledge Portal. Go for quick and short notes which you have prepared over a period of time. Highlight the board portion in the module and go through it at that point of time. Compilation of formulas in all chapter at one place and you can revise. Refer to points or mistakes I have also pointed out and you also commit during your preparation. So that is probably the error book, that these questions I make mistake and how okay, management of working capital, fine. Some people were saying that's the most difficult chapter, Mohit. But anyhow, if that is easy, that's very good. Can refer to the summary which is given at the end of the chapter. Take short break in between for revising your mind or refreshing your mind. Revise the new point or type of question from recent RTPs oblique MTPs. Then examination, do's and do nots. And reading time, read every question very carefully and underline all the requirement. Underline the important points and useful information in every question. Choose the questions which you will not attempt. Try to eliminate that in that. In 3 hours waiting time, attempt the numerical question first and probably last few minutes if it is remaining and you're short of one question, you can go for theoretical question. Solve the easy question first and difficult. If you stuck somewhere while solving the question, leave it and start the new one. Underline the main answer or you can make it a box. While attempting the theory, underline the main points and write very precisely. Don't sit reading time, wasting time and reading questions requirement only, making margin of answer sheet. That's not probably the way the time is given. Leaving any numerical question to solve for the end, solving the difficult question first, not managing time and devoting a lot of time at one question, are not giving space of one question between two question, wasting time and writing a lot of pages for 2, 3, 4 marks question, leaving a lot of blank pages. Actually, you should be cutting it across so that it is easier for the examiner to evaluate. So these are some of the do's and do nots what I would like to share with you. Thank you very much. If you have any queries, you can come back to me in next few minutes or so. Otherwise, if you have any further query, always there is a BOS mobile app. You can go to the app or you can mail it to us. I can assure you that we will be getting answer of each and every query. That's all from my side. Thank you very much. If you have any query, you just let me know in next few minutes. Or if you have any doubts, other doubts. Any doubt? Okay. I hope the concept very precisely whatever we have discussed, it's all clear to you. Then thanks. Thank you very much. And it's all over from my side from Board of Studies. Till next time, thank you very much. Yes.